Hello, everyone, and welcome to today's webinar. My name is Jonathan Brandt, and I'm a fiduciary officer with Peak Trust Company. I'm honored to kick off the second installment in our four-part series on private retirement trust. A few quick housekeeping items before we begin. If anyone has a question at any point during today's session, please use the Q&A panel to submit it. We'll be answering questions live throughout the presentation, and if we don't get to your question during the webinar, we will be certain to follow up with you afterwards. The slides for today's session are also available for download in the event dashboard. We will also email those to everyone who is registered. For those of you who may not be familiar with us, Peak Trust Company is a leading provider of sophisticated trust solutions for high net worth families and their advisors. We specialize in directed trust administration and are proud to offer flexible, tailored options for clients across the US and internationally. And our goal is to empower planners and their clients alike with tools and expert resources needed to meet complex estate planning goals. In today's session, we'll explore how to develop a defensible retirement purpose through the retirement appraisal process. You'll learn how to build a credible retirement need and funding roadmap that aligns with California's exemption requirements. To lead us through today's topic, I'm pleased to introduce our speaker, Dustin Nichols. Dustin is the founding attorney of the law office of Dustin Nichols and a recognized leader in exemption planning. He's developed a robust methodology for designing, implementing, and administering private retirement trusts. His expertise lies in combining litigation risk analysis with traditional retirement modeling to create powerful protection strategies customized to each client's unique needs. And with that, I will turn it over to you, Dustin.
Thank you, Jonathan, for that fantastic introduction. And thank you, all of you, for taking time out of your day today to attend this webinar on PRT planning with retirement purpose. It's part 2 of our 4-part series, PRT presentation series that we're doing to really highlight the areas that I think are important in terms of the overall planning for private retirement trusts and creating them and implementing them, knowing and understanding the landscape that needs to be worked through around them, and not to mention the administration to keep them maintained and working in great condition. So today, though, is part 2, retirement purpose, which is the cornerstone of the private retirement trust in terms of its validity. It has to be primarily purposed for retirement. So we get right into the next slide, which really is the introduction to retirement purpose. Now, I think it's important to look at both the statute, the purpose of the statute, compliance issues, and retirement purpose in its full analysis. In other words, how is it determined that this was primarily purposed for retirement, that totality of the circumstances analysis. So we're going to cover those 4 big bullet points today on planning with retirement purpose. So let's back up a minute and kind of just take a look at the statute to remind us what this whole thing is based upon. And the statute is California Code of Civil Procedure, section 704.115B, which states that basically all amounts held, controlled, or in the process of distribution by a private retirement plan, the distributions associated with it and the death benefit are all exempt. Now, that's the essence of the statute. It's very broad, but it's very clear that what goes in it is protected. What's proven up necessary, I should say, for retirement is exempt. Distributions, money coming out to the plan participant, 100% exempt, which is why we always have a separate distribution account set up for the client to receive those exempt distributions and not to be commingled with other non-exempt money, to make it clear that those monies are exempt. And the death benefit, God forbid something happens and the assets in the PRT need to ultimately go to their final destination. There's a beneficiary designation. We can prepare custom. It can marry very nicely with other estate planning, integrate it with trust planning and so forth. But the death benefit exemption is important. A lot of people don't understand why. I can give you a quick example. I mentioned this in part 1. Is say if you're driving down the road and you're looking at your phone and it's night, it's foggy, you cross over the line and you hit somebody coming in the opposite direction head on. You die, that person dies, their estate winds up suing your estate for wrongful death. And unfortunately, assets that are in your living trust, that maybe the trust becomes irrevocable at your death, are not protected under probate code, California probate code. So basically, those assets are subject to the creditors of the estate. This really helps to insulate at least the assets in the PRT from those claims against the estate, which is important. So back to exemption itself, the purpose obviously is important to resonate the PRT and what it really is that it does. But its purpose, like other exemptions, are to protect a debtor from his or her creditors. But in this particular case, the PRT protects the lifestyle, the need, right, to get through the end of your life. So basically to sustain and maintain the lifestyle through the into life of the PRT participant. The process that is employed, I should say, that recharacterizes the assets off of the exposed balance sheet onto the protected exempt balance sheet, which is called basically a purposeful conversion from non-exempt to exempt under case law. That characterization that takes those exposed personal assets that are identified as retirement assets and recharacterizes them as exempt retirement assets under this statute. That's the process. And what's interesting about exemptions, again, I brought this up in part one as well, but it's important again to repeat, is that these exemptions have to be construed in a light most favorable to the debtor. Where in the law do you ever see any of this inherent almost forgiveness? If you read the case law, there's a lot of it over a 50-year plus period. You see the court trying to apply these exemptions to debtors where they're just egregious attempts to take advantage and last-ditch efforts to save money. A lot of the case law is that way. It's almost, you have to look at it from a dispositive standpoint. In other words, there's a lot of what not to do's that give us exactly a framework of how this thing should look, how this thing should work. The truth is that this potent statutory exemption protection for private retirement plans is unrivaled. The purpose is to protect the debtor from his or her creditors by allowing the conversion, again, from exposed personal assets to exempt private retirement assets. And to add icing to the cake, the statute, again, is to be construed in a light most favorable to the debtor. It's just very interesting that you read case law that resonates with that message. And it's the Constitution of the state of California backs that as well, especially when you're dealing with a homestead exemption and things like that. So exemptions they're important creatures that cannot be ignored, should not be ignored, should be maximized and exhausted, frankly, to the best extent possible. And as estate planning attorneys, there's even a hint that what we're trying to do is help preserve estate assets. I don't know how we don't address that at first glance to make sure that these things are looked at and taken advantage of. Now, compliance issues, another bullet point. It's what constitutes a private retirement plan, right? For this to work, well, we have to make sure what we're using, what we're doing, is what the statute refers to. So private retirement plan is important, but we have no guidance in the statute that tells us what it's supposed to be. It just calls it what it is, a private retirement plan. Obviously, extensive knowledge of the case law is required to figure out what the meanings are in some of these things and how the framework really needs to look and how this should be structured, in my opinion, even approached to be the most effective, right? Because at the end of the day, we want to do the best we can for our clients. But backing up a second, because I get this question a lot. If this exemption protection is so great, then why don't all estate planning attorneys in California incorporate private retirement plans, PRTs, into their clients' advanced planning strategies? And that kind of gets into this issue. It's probably because the statute fails to define what is a private retirement plan. Kind of hard to do something you're not clear on what it is that you're supposed to do. And just by reference, the court in the case of In re Phillips said that the critical question for the court to decide is whether the retirement plan constitutes a, quote, private retirement plan, which section curiously and unhelpfully defines a private retirement plan as a private retirement plan. And since the statute provides no guidance as to what qualifies as a plan, extensive knowledge of the case law is really required to properly design and use a plan, which will qualify for the exemption. had the statute set forth the minimum requirements and extensive knowledge of case law would not be necessary. And PRTs would likely be a lot more popular than they are today, or at least more familiar. So what do we know? What do we know? What is the recipe for the PRT? Because, like I said, we don't have a whole lot of guidance from the statute. So what do we have? We have case law, and case law gives us the ingredients to the PRT recipe. First, we have to have a private retirement plan. It's adopted by the sponsoring company. In other words, a corporation, an LLC, another entity type that will be the creator, the settlor of the next private retirement trust, right? And there's one of these per employee. So you have to be an employee of the sponsoring company to be eligible to do a PRT. It should be managed independently by an independent trustee or custodian. Why? This is important, extremely important, because the way the PRT is constructed, it has certain anti-alienation provisions inside the trust document, which its legal effect by having an independently managed PRT is to create what's called an exclusion status in bankruptcy. In other words, and all bankruptcy attorneys will know this, excluded status means that the assets are not subject to the jurisdiction of the bankruptcy trustee. That's important. It takes an effort, extraordinary effort of the bankruptcy trustee or any creditor to try to haul the PRT back in, saying it was either done improperly for under suspicious or improper circumstances, so forth and so on. But the point is that exclusion status is very powerful. It's not just exempt, it's excluded. And to keep that, you have to have it independently managed. But the PRT does have to do one thing, has to provide retirement benefits only to an employed person. Again, to be eligible to do a PRT, a sponsoring company has to be the employer, and the PRT participant has to be the employee. Now, while these creatures, these PRTs, can be qualified or non-qualified in their constructions. In other words, they can qualify for ERISA if it meets certain criteria. I don't like that personally, because that puts the PRT up in the realm of subject to the penalties, the prohibitions, the restrictions, the jurisdiction of the Department of Labor, and any creditor disputes. All of those things exist in the ERISA world, but ERISA is a gold standard of exemption protection. There's also limits, right? And so I think the PRT marries better with other qualified plans as a non-qualified plan, not subject to all those limitations, restrictions, prohibitions, and so forth. But it still has to bear some characteristics of a plan that's qualified. In other words, it has to have a schedule or formula of payments to be made to the plan by the employee, and that satisfies the gradual accumulation component that's necessary for funding. And I'll get more into that later. There's also has to bear a schedule or formula of payments to the participant. In other words, when the PRT participant reaches retirement age, when they're going to start to get their money, their exempt distributions to go into that quote unquote exempt distribution account, not commingled with anything else. Now, although a plan is used in part to shield assets, it's still exempt if it was designed and used primarily for retirement purposes. In Rucker, it's best if the retirement plans are designed exclusively for retirement, since secondary intent can be easily construed as a primary intent, resulting in the loss of the exemption. Okay, what does this mean? It means, yes, its net effect is that it is exempt and shields assets from creditors, money judgments. That's the net effect. But it has to be principally designed and used for retirement. And Rucker, he had it connected with offshore companies that were creating these. It looked way too much like asset protection as a primary purpose, not secondary. Doesn't mean you can't do other planning. It just really should be integrated by itself on its own to do its thing, which is to provide that retirement benefit, right? Doesn't mean it can't integrate with other planning. It just means you don't want to abuse the privilege, right? And make it too associated with any other primarily purposed asset protection is all I'm saying. The reality is the PRT is the best asset protection that you can get. in California. Now, the seminal case of O'Brien versus AMBS Diagnostics LLC sets forth the now 5 factors to be considered. In other words, the totality of the circumstances considerations in determining whether a PRT is valid at the end of the day. And these are important because these can get missed very easily. And we make sure that when we do ours, that we cover every base. And the first element, the first factor that needs to be or would be considered by the court in evaluating whether or not a PRT is valid is the debtor's subjective intent. Subjective intent is huge. Now, subjective intent can kill a plan just by virtue of, well, the participant indicating that its primary intent was asset protection. That would kill it. So if asked in an examination, why'd you do this? Asset protection, yeah, you're done. It needs to be retirement, 100%. Yes, we all know that its net effect is that it's exempt, but this truly is a retirement vehicle. Chronology or timing and creation of the plan in relation to other events, that's huge too. That's why we have an extensive due diligence process to flush out any and all creditors, any potential pending, threatened, or expected lawsuits. We run an independent financial report, a lawsuit search, judgment search, all of those things to show that we have a level playing field when we do these. And chronology and timing, and in other words, when we do it in relation to what else is going on around in the client is important. We, again, will not scream retirement in favor of the client if it looks like they're just reacting to a situation that's occurring. So prong 2, very important. Degree of control. Again, we talked about that and why it's important for exclusion status, but again, also lends to retirement purpose, right? If the debtor is maintaining control over everything, the bank account and management, administrate, all of it, then it looks more like a piggy bank than it does a retirement plan in all reality. Number 4, whether the debtor violated or complied with the rules or the plan rules. In other words, what rules we do put into place in our PRTs, we just have to follow. And that's why administration is really key, because you want to have great follow-up. You want to be able to make sure that your plan's running smoothly. You're following your rules. If you make an obligation to contribute into your plan by a certain date, then meet the obligation and pay it by the certain date. And our administration service, they do an awesome job making sure that you're well aware that the obligation is coming due and that you then make your contribution to yourself. It might even be loans. You might have made loans out of the PRT to your businesses, to yourself. You need to pay those on time. Following those rules, right? Following the plan rules, all you got to do to meet the 4th factor. And whether or not, number 5, the debtor withdrew the money out of the plan or account for retirement or non-retirement. These are set up, these are modeled to provide retirement benefits, to do all those things retirement monies should do. In other words, sustain and maintain your lifestyle for the rest of your life, as it's related to where you are today looking forward. That direct correlation in time from today and where you're at, what your income is, what's your net worth, what's your horizon to retirement. And it's just important to understand those factors. Oh, and don't forget 3% inflation. All of those things are relevant to determining how much you need to put or set aside into the plan for that can be justified and exempt. There are other applications and considerations when determining these factors of validity. They're all relevant, but no one is dispositive. The inquiry obviously is not just limited to the factors, but what the federal California courts deem obviously relevant in that particular set of facts and circumstances. But they're all considered in a light of the fundamental inquiry of whether the plan was designed and used for retirement purposes. Other factors or circumstances the court may consider relevant to the second bullet point, debtor's credibility. That's a big deal. Whether the debtor overfunded the plan, that's another thing. We're pigs, we're not hogs, right? Pigs get fat, hogs get slaughtered. The contribution amount by the corporation relative to debtor's wages. In this case, it's money from all sources that we look to as well. It's not just wages when we do our analysis, and that's supportable as well. So going back to bullet point 1 of our 5 factors, I was going to launch into this a little bit deeper there, but it's more efficient and obviously more appropriate here. Subjective intent. That subjective intent, like I said, can kill a plan in an instant. But just saying the right answer doesn't get us to the end game either, but it's an important first step. Subjective intent alone is not sufficient for the creation of a PRT and justification. While the debtor's subjective intent cannot create it, it can take one away. Okay, so that's real important. It has to be primarily purposed for retirement. Barnes is a negative analysis. This is interesting. In Barnes, prior to the bankruptcy filing, debtors purchased an annuity with the proceeds from a home that they sold. The debtors asserted that the annuity was made exempt by the simple fact that they intended the annuity to fund in part their retirement. So that's how they were going to use it. At least that's what they said. But the court was not necessarily a big fan of their argument. In fact, they stated that the annuity was not exempt because it's, quote, not a private retirement plan, even though we don't have a really nice, solid definition of what it is, what a private retirement plan is. We do know that it has to at least bear somewhat of a appearance of being a plan, and there's no plan that can be even denoted from these facts. And the other important point is that the court said that it wasn't exempt, the annuity, because it didn't represent gradual investment of contributed funds. So earlier I was talking about funding, right? I have a whole part in this series that just addresses funding. That I highly recommend you attend as well. But there's basically two ways to fund, and both of these I think are relevant. It's some lump sum contribution, and two, that we have some gradual money in over time. And that money in over time supports that construction of a retirement plan or look and feel. The court in Barden says that a plan requires more than an instantaneous transmutation of a lump sum of previously non-exempt money or other assets into an exempt retirement plan. It also contemplates the gradual accumulation of money to fund a future retirement. And this is supported by the language of the statute, which provides that a private retirement plan means private retirement plans, including but not limited to union retirement plans. And that's California Code of Civil Procedure, section 704.115A1. Union retirement plans provide for retirement income funded by an employee and employer, and annual contributions made over a long period of time. And in this case, the debtors purchased the annuity with proceeds from a home sale. The annuity was not purchased for the debtors by an employer, nor did it represent the gradual investment of contributed funds. So it really failed on all of those fronts, even though you got to give them credit. It was a novel attempt at an argument, but again, further at least gives us some guidance on what a plan is, right? And what it might or should look like. And the factor two that's also important to consider, that chronology of events. Chronology of events is important. Again, we're looking at what's going on around the debtor at the time that they created the plan. That's all relevant because any of negative facts that may exist could undercut or somewhat dilute retirement purpose. And obviously we don't want that. And that's why the significance of the due diligence engagement that I mentioned earlier is really critical. To spend the time. We don't do a PRT until we spend the time that we need to understand, one, what the client has. We do a full asset valuation gathering to understand what does the client have and how much it's all worth, what liabilities exist around personal guarantees, anything there that could potentially create an argument of insolvency. Because I can tell you that PRTs don't work, or anything else for that matter, to the extent that a client enters into a transaction with involvement and they owe more than they have. And it could also be in the form of a lawsuit that's against them at that time, where it's been determined that the contingent liability associated with that is excessive. And we do a full contingent liability analysis. My senior associate, she's a litigation analyst, and she looks at these lawsuits and she helps to determine what the contingent liability might look like based on the Zonix and Covey cases. Those are bankruptcy court cases. And they provide for some formulas that give us some persuasive authority. It's not mandatory, but it shows that we've spent the time to respect the rightful entitlement of a potential creditor. That's huge because one of the biggest, or I should say most often used methods by a creditor in California to set aside transfers under the Avoidable Transactions Act is the intent test, which basically provides for that the debtor intended to defraud, delay, or hinder the rightful entitlement of the creditor. And that doesn't have to be necessarily clearly denoted by what he says or she says, but by what they do or what they don't do. There's a lot of things, badges of fraud of old, those still are survive today. So actions can dictate intent. So showing that we've spent the time to go through and respect these claims, potential claims, in my opinion, helps to clear a path even better for the future, that we can say, hey, this is 100% retirement purposed, even if there was an issue surrounding it. And as long as the contingent liability didn't exceed, obviously, the net worth of the client or the amounts we're going to plan with. So in a positive analysis, a Stern case, very interesting case. This is one of the cases where my eyes spun in the back of my head when I first read it, and not a lot of bankruptcy attorneys love it, but it says what it says, and it's still a good case. But Stern transferred plan assets into an IRA. This was done in the throes of a $4.6 million arbitration award against him in 91. So he creates a profit sharing plan in 92, transfers the proceeds of the IRA into the profit sharing plan, which, by the way, falls under the statute, under the PRT statute. And the creditor files a fraudulent transfer action, basically contending that the transfer was fraudulent and only designed to shield the assets from creditors. Well, Stern filed for bankruptcy after that, and the creditor removed the fraudulent transfer action to the bankruptcy court as an adversary proceeding. But his transfer of assets from the IRA to the pension on the eve of bankruptcy was, the court said, not a fraudulent transfer designed to shield his assets from creditors. That went through me. And then even that language that I used earlier, that purposeful conversion from non-exempt is not fraud per se. This is the case. That basically stated that. So with the exception of a multi-million-dollar arbitration loss and speculative insolvency, the other articulated badges of fraud are simply restatements of the accusation that the debtor converted non-exempt assets into exempt assets, an accusation that cannot support a finding of fraud. This is the court saying this. And the allegation that the debtor, quote, may have been insolvent when the transfer was made is speculative and thus discounted when raised in defense of a summary judgment motion. Thus, remaining is the fact that debtor lost a multi-million-dollar arbitration. That single unspectacular fact does not meet a preponderance of the evidence burden of proof. That was the court. I found that interesting. And again, all this to be taken in a grain of salt because every single action is different, but it gives us an idea of the feeling around exemptions and the treatment exemptions, the enforcement of exemptions, which in my opinion is drastically different than just traditional enforcement against straight transfer planning to domestic asset protection trusts or whatever, especially in California. What we're really talking about is very kind of a California specific mentality. The court's attitude in California towards these things just aren't that great when they're looking at asset protection. In fact, there was a case, just this quick sidebar, there was a case in San Diego in 2014. It was the Kilker versus Stillman that basically stood for the mere transfer to an asset protection trust in Nevada is fraud. Obviously, that's minority, but it just gives you an idea of the flavor of the courts and how they can look at things that they're unfamiliar with here in the state. So negative analysis, O'Brien versus AMBS Diagnostics LLC, the judgment's creditor sought to collect money from O'Brien's IRA. The court declared that the IRA funds were only partially exempt. Weeks later, O'Brien created an LLC and soon thereafter created 401k, adopted the plan, rolled over the IRA into the 401 play and claimed it fully exempt. And then O'Brien dissolved the LLC. The chronology of events confirmed in this particular case, O'Brien's subjective intent was to shield the assets from creditors, not to create a valid retirement plan. The debtor wanted the exemption for retirement plans under CCP 704.115B because under subsection E, in other words, for IRAs, An IRA is exempt only to the extent necessary to provide for the support of the judgment debtor and his dependents when the judgment debtor retires, taking into account all resources that are likely to be available at the time of retirement, where it will be a number of years before the judgment debtor will retire. The court will take into account not only the assets of the judgment debtor at the time of the exemption claim is determined, but also the assets and income, including pension rights, that the judgment debtor is likely to acquire prior to retirement. So why I am a big fan of the enhancement I call exemption protection potential, to the extent we can move IRAs in 401ks, since we don't get the under state law much protection for IRAs in California. We certainly wouldn't mind recharacterizing those assets to achieve what I call the gold standard of exemption protection, which is ERISA protection. This guy just did it all the wrong way and under the wrong circumstances to evidence, well, his intent, which was not to create a real valid private retirement plan, but rather, or I should say, he used the tools that were given to him improperly, I think is the best way to put it. Degree of control. This is important. Again, we don't, control is that hot button that could destroy that exclusion status that we referred to earlier. That's so important for these to really do and be able to perform, especially in bankruptcy. The kind of control which would show what we call a non-retirement purpose above and beyond the exclusion status, but just the retirement purpose evaluation in the PRT when it's being looked at. The kind of control that would show a non-retirement purpose would be substantially all control over contributions, management, administration, and use of funds. This is why we prefer an independent trustee. Now, full transparency, there is case law that says the participant can serve as PRT trustee, but an independent custodian or trustee is preferable, like Peak, and safer, since the exemption can be lost if the participant exercises a high degree of control over the plan. So acting as your own PRT trustee is frankly just an invitation for creditors to attack it based on degree of control. Now, in Ray Chang, this is an interesting case. The debtor was the sole owner of a corporation and sponsored the private retirement plan. The debtor was the trustee, the debtor was a beneficiary, and the debtor controlled the plan and the assets. In 1991, in Ray Chang, the court addressed the issue of whether a corporate retirement plan in which one person controls the company and the plan qualifies for a private retirement plan exemption under 704.115B, or whether it must be treated as a, quote, self-employed retirement plan under subsection A3. The court held that a plan sponsored by a wholly owned corporation qualifies for the full exemption, and stated that, quote, although the legislative history indicates that the policy behind section 704.115 is to limit the exemption for plans that are controlled by one person, the statute says what it says, and it was improper for the bankruptcy court to read beyond that. If the California legislature intended to treat closely held corporations differently than large corporations, it could have done so explicitly. So at the end of the day, it means that you can have a single shareholder, single officer, single director corporation that can adopt a PRT for the owner, shareholder, participant, and that it received the same protections that a General Motors, and this is out of the case, or an IBM pension would provide its employees. And so this case is huge, because how many clients or business owner clients of ours do we have that don't have more than maybe the husband and wife as the owners, and they're doing very well. They can do a PRT. On a positive note, in Schwartzman versus Wilshinsky, the court found that a high degree of control was not exercised because the debtor did not take loans or disbursements. Debtor did not overfund. Debtor had no part in administering the plan, i.e. independent trustee. And there was no evidence that debtor used the plan to hide assets. Again, that's what in a lot of these old cases, like the last ditch attempts to try and hide money before going into bankruptcy, some of them working, some of them not. It's funny, the breadcrumbs that are laid from these cases really give us exactly what we need to do this the right way and have it work. The fourth factor, the compliance aspect. Again, this is not ERISA, so we don't have IRS rules. We don't have reporting that we have to do to the extent that we would do it under the qualified realm. What do we do? Again, we still have certain things that we need to do, that we should do as a plan. We have to follow the trust rules, the plan rules, eligibility, investing, all these things. Set the rules, and we just have to follow the rules. Also file our tax return every year for the trust. It's a grantor return, it's a 1041. It's informational because this is a grantor trust. If you recall from part one, it's an employee grantor trust under 678 of the Internal Revenue Code. So it's a look through, it's a disregarded entity. So whatever the PRT makes, it gains, its losses, even tax credits, even cost seg studies and for advanced depreciation and get income tax, all that still goes to the owner, the grantor, in this case, the employee. They can take advantage of any of the benefits that you could take advantage of, the plan participant could take advantage of, right? But we file our returns, we do what we're supposed to do, and again, we follow the rules of the trust to make sure everything goes and runs and works smoothly. So overfunding, this is what we would call an outside compliance issue. This is bad because if we set forth contributions that only what we can make, in other words, what's the total amount that we can justify necessary that this PRT participant needs to sustain and maintain their lifestyle for the rest of their lives? Well, there's still an opportunity for a lot of people that say, oh, you know what? I'm just going to put more in here. I'm not really going to tell anybody, or I'm just going to stuff more than I can justify. That's a compliance issue. That's bad for this particular factor in getting past that. And Rucker is a perfect example of what not to do. In the matter of Rucker again had 3 wholly owned corporations that he used to establish a pension plan and several 401ks. He was the only Benny of all of those plans. The corporation contributed at least $30,000 more to Rucker's plan than he paid him in salary. Now these particular plans are qualified plans, not non-qualified. It's important to note that. And plan contributions were equal to his salary. All right, so everything there just looked wrong and certainly was out of the ordinary and screamed that, hey, this guy is trying to hide money. I don't think anybody can deny that's what he was doing. And this is just the court picking it apart at the end of the day. And the one thing that we take from this is that the plans that are not designed and used primarily for retirement, and therefore they're not exempt if they're not used primarily for designed and used primarily for retirement under 704.115. The court said in this case, he said Rucker engaged in egregious and deceptive conduct in funding his plans. He consistently funded his plans in excess of the contribution limits imposed by the Internal Revenue Code, and he repeatedly and willfully lied to the IRS about the extent of his plan contributions, which is never a good thing. Rucker also secretly contributed his money to plans using a wholly owned offshore corporation and a foreign bank account. Rucker gave no explanation for his misrepresentations or why anyone with a genuine retirement purpose would underreport the amount of money contributed into the retirement plan or secretly contribute from an offshore corporation ineligible to participate in the plan. Rucker's behavior in hiding his contributions and lying to the IRS is more consistent with, quote, a primary goal of hiding assets than with the primary purpose of saving for retirement. Then factor 5, we get into the withdrawals and loans subject. And this is interesting because in a good way, it's a case that stands for you don't have to stop working to receive retirement benefits. But in this particular case, if the debtor withdraws money from the plan or account, whether those funds were used for retirement or non-retirement purposes are, well, important to the evaluation. Now, if a person is working, maybe they manage their own real estate, maybe they have other business endeavors, but they are slowing down, right? And the issue is supplemental retirement. In other words, they won't have to work as much, but they still need to be able to make as much money, right? This Jackaway case basically stands for that you can start receiving retirement and not have to stop working completely for that reason, right? The courts have considered whether the withdrawals or loans benefited the plan's retirement purpose by preserving and enhancing the capital of the plan, and whether any withdrawals diminished or will diminish the assets in the plan to such an extent that they are consistent with the majority of the assets being used for long-term retirement purpose. So in determining basically whether the loans taken by the participant destroyed the retirement purpose of the plan, the court considered whether the participant, quote, followed the procedures set out in the trust instrument for obtaining loans. See, Jackaway took a bunch of loans out in ahead of receiving distributions on schedule. And the question was whether those loans, that money was exempt as withdrawals or that had retirement purpose. In this case, they were. In Bloom, this is a positive analysis. Loaning more than half the funds in the plan to herself without security did not negate retirement purpose. And when I read that, I went, what? And then I kept reading, and I realized that Bloom did some things that were good. The policy plan procedures were followed, charged reasonable rate of interest. Paying back the PRT with a reasonable rate of interest shows respect for the money that was in the plan. Timely and continuous payments. You're not paying once in a while. You're not paying when you feel like it. You're paying your PRT back when you're supposed to. No evidence of any attempt to hide. There was no evidence in this particular case of any attempt to hide. It says that the court said it's inappropriate to hold a debtor to a prudent investor standard. Poorly, even imprudent invested plan may still be designed and used for retirement purposes. Maybe it's helpful to dive into Bloom a little bit more, just to get the facts around it. In '98, the debtor was one of two owners of a medical corporation that created a private retirement plan and a profit sharing plan, in which the two owners served as the trustees. The debtor made a number of loans from the plans to herself in exchange for unsecured promissory note, and only made interest payments to the loan, not principal, which meant that a significant portion of the plan assets were unsecured promissory notes. That right there, right, would raise a flag. But the court held that the plans, quote, were not so abused as to lose their retirement purpose because they followed the plan procedures and policies. They charged a reasonable rate of interest. They paid their payments on time. And there was no evidence of any attempt to hide the assets. So the court in this particular case said, as long as you do these things, retirement purpose is not thwarted, and the PRT would be upheld as valid. Now, in Ray Daniel, things didn't work out so great for this debtor. In this particular case, the debtor borrowed $75,000 from a plan to buy a house, agreed to repay the loan in a year, even with 10%. Great, right? No interest payments were made when they were due. The loan was rolled over, and the plan got a new promissory note payable to himself as trustee. Now we start to see this kind of self-interested, egregious behavior that happens. I don't know about you. I've seen it over my 30 years of practice in various variations, if you will. But it exists, unfortunately, and I call that when my clients unfortunately get what I call the attack of the clevers. And they just decide to go and try to do things on their own. They don't talk to us. And that obviously can lead to problems. When we put this stuff in motion, we hope that the clients are following the rules. Thankfully, at least in the PRT context, we have administration. So it's very hard not to see when they're not doing things they're supposed to do, or if they start to do things that they're not supposed to do, which is always helpful. But in this particular case, the court looked at it and said, you know what, the transaction was more than a withdrawal, than a loan. It didn't fit. The elements of a loan. It just looked like a straight taking of the money out of the plan. And the reason for that is the debtor failed to establish the ability to obtain similar funds commercially. Always helps to first go out and see if you can get the money before you borrow it from your retirement. Unsecured nature of the loan at a favorable rate of interest. Amount of withdrawn was substantially equal to the debtor's interest in the plan. So he basically bled it. And the debtor rolled over his payment. In other words, it was time for him to pay. He just renegotiated his loan. Now, some facts. Debtor was the sole director and shareholder of a corporation that formed a pension and profit sharing plan managed and controlled by debtor, and debtor being one of the four beneficiaries. The plan debtor great latitude in withdrawing his beneficial interest. The plan could be amended and terminated at will by the employer. The debtor was entitled to borrow against his interest on an unsecured basis with virtually no constraints on repayment. And contributions totaled approximately $128,000. The plan essentially operated to meet debtors' short-term personal needs by lending money or shielding and hiding funds from creditors. And the debtor failed to show his transactions with the plan by virtue of his role as trustee were really in furtherance of legitimate long-term retirement purpose. But keeping in mind that the court's findings are based on, quote, the totality of the circumstances and not the withdrawals alone. It's the behavior around this. The other factor the court focused on was that 2 weeks before filing bankruptcy, in this particular case, the debtor caused his corporation to contribute $39,000, which was all the available cash to the plan, a contribution that totaled nearly twice the largest contribution ever made, was made mid-year, and was not based on any profit calculation. So again, stands on its own, speaks for itself. However you want to look at it, it was just all bad. So when we take all of this and we take a step back, what do we have? What's the recap? The assets in a PRT only benefit from the exemption protection of 704.115 if the PRT is properly structured. Again, taking into consideration all of these things that are going on in advance, really exploring the 5 factors, looking backwards and clearing a path for the client in that due diligence phase, I think is really important. And that we design it correct with the, well, showing the correct purpose. This is retirement fund. It's meant to accumulate in over time. We have, lump sum in there now, but all of it's meant to sustain and maintain this debtor's, this PRT participant's lifestyle for the rest of their lives. And funded, properly funded. We don't put personal use assets in here. We talked about that in part 1 of the series. What are the appropriate assets to fund into the PRT? We can't put a Ferrari in there. Probably not a good idea to stick your boat, all right, unless it's in an LLC and it actually is a business and cash flows. You can't put vacant land, although we could probably lean it in favor of a PRT contribution. There's just, you have to make sure that what we put into this thing is appropriate for what its purposes is. In other words, to provide that retirement benefit. If it's not going to contribute in some way to paying the retirement benefit when it's time to pay it, then it probably doesn't belong in there. And annually administered to maintain compliance with applicable laws. Again, we set forth the rules, we follow the rules. We have certain other compliance, tax returns, right? Where we make sure that clients have their benefit statement on an annual basis that shows what's in the PRT, the cash flows, the balance sheet, all of these things, and the plan report that basically is the retirement story. And I get really deep into that in the other part of our series that talks about PRT funding. And that's important, it really has to resonate. Appropriate. In any event, the PRT can be flexible and powerful, but as with any in all trust and entity planning, it is only as good as the individuals appointed within the instrument. Your cast of characters in your PRT are really important to its future success. Having a solid trustee like Peak, highly advisable, they know what they're doing, they drive the bus to the destination. That's what you want. I think that's important. Your PRT trust protector is also important. This is somebody that's overseeing. There's offices in the PRT, and we actually talked about that in part 1, where we get into the various capacities. It's not over the top. It's the same standard things you would want to see in a trust structure that's obviously familiar to a lot of people, that has elements of domestic asset protection trust kind of structure and others. In other words, more modern trust structure is really the more appropriate thing to say. The retirement appraisal and analytics, what are we proving up? Like I said, telling the retirement story. Why are these assets in here? How are they going to contribute to paying the retirement benefit? I think that's huge. And the administrative support. So hopefully what you walked away with today is the fact that PRTs have to be primarily purposed for retirement to be able to do their job to protect, exempt, those can't lose retirement assets in your portfolio. That if we follow the rules, we create these correctly, it's all done in the right order, and we respect these potential claims, issues that are out there. We pave the way for success, I think, in days going forward. And that's really important for our clients. And certainly I'm here to answer questions, should anybody have any. And I certainly thank you for your time and attention for today's presentation. And I look forward to seeing you at part 3.